Welcome to the Sage Planning Solutions Podcast. Join Brad Marshall, Patrick Bennett, and Dominic Ruiz as we help you navigate life's financial obstacles and find financial freedom. We will cover the major pitfalls that can derail your journey to financial independence. Get ready to learn, grow, and prepare for your best possible financial future. Securities and advisory services offered through Cadaret Grant & Company Incorporated, a registered investment advisor and member FINRA SIPC. Cadaret Grant and Sage Planning Solutions are separate and unaffiliated entities. The information provided here is for general informational purposes only and should not be considered an individualized recommendation or personalized investment advice. Any opinions or forecasts contained herein reflect the subjective judgments and assumptions of the authors only and do not necessarily reflect the views of Cadaret Grant & Company Incorporated. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. This information is not intended to be a substitute for specific individualized tax, legal, or investment planning advice. Neither Cadaret Grant & Company Incorporated nor its registered representatives or employees provide tax or legal services. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice.
Welcome to the Sage Planning Solutions Podcast. I'm your host, Dominic Ruiz, and joining me today are my two co-hosts, Patrick Bennett and Brad Marshall. In today's episode, we will dive into the intriguing question of how did they get it so wrong? We will be addressing the unexpected 2023 bull market and the predictions from economists, financial media outlets, and equity analysts. The general market and economy at the end of 2022 was extremely bearish. Everyone was focused on key topics, which were inflation, geopolitical tensions, and interest rates. Imagine if we focused on all these fear-mongering issues as a primary driver of how to allocate portfolios. I think I'd be stressed and confused. So gentlemen, I'm going to ask you three different questions. One, what type of concerns did your clients have coming out of a bear market in 2022? Two, how did you address those concerns? And three, how did those concerns evolve throughout 2023 as the market continued to rise?
I think I'll take a stab at this. I think this illustrates the challenge that using predictive ideas about what is going to happen with the market. And we've got wars breaking out all over the world. We've got economic wars taking place. We still have some supply chain issues. We've got rampant inflation. The market was down significantly. And so clients are understandably nervous. But if you look at historic market returns when something's always going on, right? There's always a war. And there's always interest rate issues, right? Whether they're going up, they're going down artificially, as in the case of post-Great Recession. And so people, understandably, especially if you're watching the news on a regular basis, have real life concerns. But, the market's inefficient, right? The market's down. It's, buy when, most people are fearful and sell when most people are greedy comes into play when the market's down. And it looks like the globe is falling apart. The macroeconomic environment is terrible for investing. That's the time you've got to have the discipline to start buying and stay put. And of course, we as financial advisors have to respond to our clients' concerns and hopefully keep them on track and keep their investment objectives in place.
Pat, what were some of the concerns you heard from clients? How did you address those? And how did those concerns evolve throughout the year as the market continued to rise?
As a buddy of mine once said, when it comes to investing, there is no free lunch. And when the mass media curates a podcast, a television show, whatever it may be, it's all to create a reaction to get people to watch it. So I would almost kind of put out this little test that says, if there is somebody who does not have social media, does not have a cell phone, does not watch TV, that person probably is going to outperform everybody else, right? And that's just sort of this little concept that I play with. Because the only thing that we really get out there, the only thing that you could really put forward as an advantage that you're going to have over anybody else are two things. It's diversification and investor behavior. And if we get caught up in the story, if people get caught up in worry, if people get caught up in all of the things that everybody else is saying, tough way to go. Very, very tough way to go. Tough on your mental health, tough on the bottom line, tough on everything. So I think the key to all of this, and I hate to drill it down to this, but I think the key to this is having a really, really good relationship with your money, having a good understanding of what my budget is, and then having a financial advisor that you can talk with very, very honestly. Because most of what we interact with in social media, the mass media, print, if that even still exists anymore, is everybody's selling something. Everybody's selling something. So anybody who gets on and defends what their portfolio did last quarter or last year, they're selling something. The guy Bill Gross, who gets and talks about, hey, this is where bonds are going, and this is why I believe that, he ran the biggest bond fund in the world. Once he saw that the bond market was at the bottom here about 10 years ago, he quickly left and went to an equity shop. Everybody is selling something. Only thing that we can do is have those clear and honest conversations about what does risk mean to me? What does my money mean to me? And that makes everything else dissolve right in front of you. What about this war? We can deal with that. What about the pandemic? We can deal with that. So I'm just not going to get into the weeds on all of the different little things that come up, because the most valuable thing is say, hey, listen, I'm going to talk to my financial advisor next week. We'll reassess my goals, risk, time horizon, max drawdowns, right? How much am I willing to lose on a month-over-month basis? And sometimes, as you guys know, people are saying, hey, if the market's down like it was in Q1, Q2 of 2020 when the pandemic hit and everybody was wondering what's going on with the planet right now, if you stay invested, you made a lot of money. You made a lot of money. If you took the bait and said, I just think I need to go to cash while everything else settles down, guess what? You're done.
Well, it's a good point, Pat, regarding COVID, because, we had a lot of clients called in and said, hey, we got to get out, right? The globe shut down overnight. Everything, every business, everything. There was no reason for the market to recover. There was no reason for any sort of optimism or positivity at all. And the market dropped significantly over that 6-8 week period. And not only for no reason, because no businesses were open up that year. I mean, you couldn't even leave your home. Not only did the market completely recover all of its losses, but finished up for the year. So the few people that we couldn't convince not to sell, we got them back in eventually, so everything was fine. But most people followed our advice, which is why you need an advisor, because if you're doing it on your own, invariably when the entire globe shuts down, it's going to be a very difficult thing not to sell. And then when you're out, when are you going to get back in, right? I mean, the market's down 30% in 6 weeks. That seems like the best time to start buying. But that's, I heard a quote early in my career and it stuck with me throughout my career. The person who gets out at the bottom and the person who gets in at the top are never the same person. So if you timed it right and you sold high and the market dropped, you're still going to be too paranoid to buy in at the bottom. And if you're the other person who, called it right and bought at the bottom, if the market goes up, those people invariably stay, I won't say greedy, but stay overly optimistic and think the market's just going to keep going. So
that reminds me of how many times on Twitter I've seen, or X, excuse me, I've seen folks that make a post that says, well, if it gets to this price, or conversations with people, if it gets to this price, I'm buying. Get to that price, they're not buying because they're still scared and they don't have a plan. But they started off with one, they'll announce, oh yeah, if I invest money, I'll wait for a market correction. The market correction comes. And then they're like, well, no, I think it's going to go lower. So it's that behavioral bias, right? It's that fear aspect. But 2020 set the stage for 2022. And 2020 was also a year that was not normal. It doesn't happen very often. But when they do, the volatility increases, but also the recoveries are a lot faster than they were 20 years ago, which would take months or years to catch up, where now we can do it literally in weeks to months. And coming into this year, like I said, a lot of people made bad estimates, but not relying on the fundamentalists. I like looking at charts, because if we look at a chart, it's going to tell us a completely different story. And it really covers the basics of supply and demand, right? Where people are buying, where are they selling, or where are anticipations happening. Whereas the fundamentalists, the economists, financial media outlets, and analysts, they look at them and create a list of what to buy, right? Based on balance sheet, earnings, where on the technical side, the charting side, it tells you when to buy. So I think those help people significantly more than just relying on an analyst and an opinion, because as Pat had mentioned before during conversations many times, is when analysts congregate and they come up with the consensus, they all roughly are very similar, because they don't want to be the last person out, the only person standing with that projection. And if they're wrong, they might not be able to keep their job. Do you recollect saying stuff like that, Pat?
Yes. The thing that sort of shocked me is when you start to, we've all been around long enough, so we start to make relationships with some of these people. then you can get them to talk really honestly and very candidly with you. You'll find out that so many of the decisions that are made has everything to do with their own compensation. Because if I say, hey, listen, we had exposure to this and it did really phenomenally well. Great. What was their exposure? It was 1% of the portfolio. It's de minimis when it comes to return. I see it on paper and that looks nice, but I didn't feel it. Right? I look at it and there was no real benefit to it. And the reason is that when these managers are looked at in comparison to their peers, that's a lot of how they make their comp. How much did you do versus your peer group? How much did you outperform the index, right? And it's also, we see this happen. We used to see it all the time in October, is we outperform the index by 150 basis points, sell everything, lock in those gains. Let's make plans for Aruba. I mean, I'm not trying to diminish these people, but the reality is that people respond to incentives. And when you are driving these big battleships, these big, huge mutual funds, you're going to do what you have to do in order to make your comp. So I believe that when you're working with a financial advisor that is independent and then is a fiduciary, they can help you make decisions that are based clearly not on all of these strange hidden underlying issues, but on purely like, what does your money mean to you? What sort of risk are you willing to stand up to in the face of all these different things? Brad said it earlier, when the globe shuts down and everybody's wondering what to do, I'm not going to worry. I might a little bit at 2:00 in the morning, but when we have to get to work, we have to do the math. And if the math says, hey, look at all these consumer staple companies that have balance sheets that could literally get through a global shutdown, and we could literally go out and buy $1 worth of value for 75 cents, you just realize the market climbs a wall of worry, and this too will pass. And the people who go out there and do the math on these things are just way too smart and way too shrewd to let emotional overreaction cloud their judgment for too long.
Yeah. And I clearly remember at the end of 2022, maybe the last couple of days, I'd get phone calls with clients trying to address the concerns. Oh, what about inflation? What about war? What about interest rates, mortgage rates? And the market started bottoming in the early part or the mid part of October 2022. And we could start seeing a shift. I talked to you guys about that and showed you why I think that would be a reasonable area to start adding equities. And the chart told you all you needed to know. So really trying to address concerns from clients using charts, right? I would do a Zoom with them. No matter what their age was, it's intriguing for them to see these types of things because they've never been introduced. They've always been relied on analysts, the news, fundamental things, and showing them and keeping them very basic. People are very visual. I know I'm visual. I'm a conceptual learner, but also more of a visual learner. So being able to see those levels of supply and demand that I told you guys about, I can justify, hey, this is what I see happening. And as the year progressed, I would just go back to the original things I was showing clients, via Zoom on the charts. And they would say, okay, well, now that makes sense, which separates me. I don't listen to a lot of news. I don't listen to a lot of opinions. I really just let the market help me with the decisions because you can see what's evolving, what's happening, what are the long-term trends in each sector, each industry. And I allow that to help me with a lot of the heavy lifting versus just relying on the news or a fundamental opinion.
What shocks me is how many people in our industry rely on what is fed to them through different investment management companies. And remember, those people are there to sell dreams of future success. And they're going to make recommendations without any regard to your conversation with your client. And sometimes, and I've been guilty of this too, like, hey, I spoke with a guy who is a representative for XYZ gigantic company, and they said that at the top, their feeling is that this and this and this is going to happen. And they don't have they're never going to be held accountable for what they said. I'm not saying that they misled anybody, but they're just going to say what they're going to say because they need dollars coming in and they need dollars sticking around. And so if you get somebody in the financial industry who basically takes the spoon-fed story or narrative from these people, like I said, I've been there and it's tough. You don't know what to do. And you say, well, let's leverage our experts. Let's talk to the smart people. But at the end of the day, they're not held accountable for anything that they say because they're never going to talk to your clients and it's never going to trickle up to them. So it's really incumbent upon, like, for example, the work that you do, Dominic, the work that we do with Horizon, to have input given by a company that is not overall compensated for making sure you stay invested with them, because that's how they make their money. For not having an investment bank, for not having a proprietary trade desk, for not having buy side or sell side, hey, go out and buy gold. We're very bullish on gold. Well, it's because they have too much gold lying around. They need to sell it. So they're trying to create a market. We all know intuitively this is happening for, all of our clients to say, isn't the stock market rigged? No, the market's not rigged, but is the industry a little bit rigged? I think it is, right? I think we'd all be kind of foolish to think that it's not. But the good thing is we can protect our people from that. I've certainly been protected by that. And we've certainly protected our clients from that to an extent.
Yeah. And one of the things that Dominic's really great about, and you've got to remind me too, and, remember, we're financial advisors. We've got 50 years of history between us, but we're also human, right? And apart from just the system being rigged, and I agree with you, Pat, wholeheartedly, that we have these investment committees come in and tell us what they think is going to come to pass. And yes, they benefit from it, they profit from it. But I also do think sometimes their heart is in the right place. And so this, again, illustrates the sort of the difference between qualitative and quantitative analysis, right? I mean, yes, the cause effect. If the dollar's weak, then gold should go up, right? So, it may not be that they benefit from you buying gold, but if the cause effect truly comes to pass, then it does make sense. But as we know, the market's inefficient. The cause effect, it doesn't always, happen exactly like it's supposed to. Right? Otherwise, it'd be easy, right? The economy's weak, let's get out of the market. The economy's strong, let's get in the market. And Dominic's really good about reminding me and managing portfolios according to a combination of, yes, what's going on globally, yes, what's going on in terms of the cause effect, but let's look at, Dominic says it to me all the time, the market is a leading indicator, right? So in October of 22, again, there's no good reason for the market to recover. It's all bad. They're going to raise rates. They're going to continue to contract the economy. We've got to strengthen the dollar. Rising rates, apart from, sort of staving off inflation, also strengthens the dollar. So there's just no way things can get better in these circumstances. I go to Dominic, and Dominic, I remember just you saying specifically, almost to the day, hey, the market is going to start turning around. We need to start buying technology. We need to start. And so using a combination of the qualitative and the quantitative, I think, is serving us obviously very well, and sort of, again, as experienced financial advisor, just eliminating a lot of that white noise and looking at what is true as opposed to what we think might happen.
All right. So here's my pushback on that. So first off, I agreed with very much just about everything you said there. However, I do believe that there's a playbook that Wall Street has used for decades and decades and decades. And that playbook is, let's prey's too strong of a word. Let's use and pull out these old chestnuts that we've used before that personally I just don't think really work anymore, right? And you said it perfectly. Hey, when the dollar weakens, gold goes up. I don't really see that anymore. Or when the correlation between stocks and bonds, right? This is the Ibbotson Markowitz theory that, a lot of investment companies built the entire backbone of their companies on, right? And it has to do with the correlation or lack of correlation between different asset classes. But when I grew up is in the end of 2008 in this business. Okay. I was in it in 98, but here's where I grew up in 2008 when you realize diversification did not work. It didn't work. And it's like that one old, there's a guy on the moon and he's holding up a feather and he's holding up a hammer. And he drops them and they both fall in unison at the same exact time. And then they were trying to prove some Newtonian law of physics. But I was thinking, this is what's happening in the market right now. And there was the housing crisis and there was lots of bad loans. There was a whole issue with stuff there. But what it made me realize is that those old stories, those old saws and chestnuts that the market used to really rely on and depend on, these things are being trashed. They need to be re-examined. And Dom was really the one, I think, that really says, Pat, honestly, buddy, it all depends on price. What are people willing to pay? So we can get as cute as we want, talking about this fund, this stock, this bond, this, I'm not going to say alternative asset class because I don't want anybody to get too excited. But at the end of the day, diversification is all that we have. And I think the best thing, and I told Dom this the other day, man, if I ever retired, I am not doing this thing by myself. I need somebody helping me, because if I'm not going to stay connected to the markets, it's just moving too fast. So if I have a good connection with my financial advisor, he can say, yeah, this 10% of the portfolio, it's really going to struggle. This other 10% of the portfolio, it's not really going to move. It's going to be rock solid. This other 60% could go up, could go down. But I can tell you one thing, here's a handful of companies that are not going to go out of business. They survived the economy shutting down. They survived the globe shutting down. They survived the financial crisis. And that's why I believe in balance sheets. And I also believe in price. So that's sort of a yin to your yang. I do believe that there's way too many stories that are told that the storytellers really want people to believe in good times and in bad, because I believe that in some way it's dishonest and manipulative. At the same time, those same stories, they could also be comforting. Oh, that's right. We should do this, and this is what you do. I just think that lack of correlation has really just sort of destroyed a lot of those old, maxims and age-old wisdom. And I would just sort of stay with my favorite one, which is, if it's the easy thing to do, it's almost always the wrong thing to do. If it's the hard thing to do, it's almost always the right thing to do.
Yeah. I want to hear from Dominic, because we've been talking a lot about the foundation that he lays for us. But Pat, I just wanted to touch on something you said, which is, when I retire as a financial advisor, you're too smart, or you know more and you know enough to let somebody else hold your hand and guide you through this. And a lot of folks think they could do it on their own, or think that their advisors should be, outperforming the upside and not lose money when the market's going down. But I mean, if you think about the group we built here, we rely on each other. We're already not doing it on our own. I was alone for years when I started my practice, and it's a lonely place to be making decisions in a vacuum. And so it's great to be able to work with a group of people who have differing opinions, right? So we don't have groupthink. I mean, I think all three of us have very different opinions, but I always fall back, because I freak out sometimes. I mean, let's be honest, right? I mean, the COVID was weird. 2022 was odd, right? And so, when I call Dominic and he talks me off the ledge, even with the decades of experience we have, it's great to rely on the opinions of people who we respect, trust, and admire. So anyway, we don't do it on our own either. And so, Dominic, we're talking a lot about all of the work you do behind the scenes. So I'd love to hear your take on all of it.
Well, thank you, gentlemen. Appreciate it. To sum up a lot of what you're both saying, because I agree with both of you guys, I think when you're working with an advisor, you should be working with an advisor who is surrounded by a team, and that has a pulse, or someone on his team has a pulse on what's happening day in and day out, versus the person, as we're taught in our industry, and you'll probably won't hear this, but we are taught in our industry to be what's called, quote, asset gatherers. Problem with an asset gatherers, we should be golfing all day. We should be doing brunches all day. We should be doing this, that, and the other. And they don't really have much idea what's happening with the market. And if they do, they're not asset gathering all day playing golf. So they tend to rely on external vendors or someone, and they'll delegate that investment process to someone else. And if I was a client, I want somebody on the team to be able to walk me through the markets and be able to look underneath the hood and tell me what's going on, versus just investing money in some allocation. Diversification, I think, is watered down. And the reason why I say that is because why do I want to own assets that aren't performing well? There's no point. So why am I going to own something that's lagging? And that's the problem with diversification, is it'll make you own 2 or 3% of something that isn't doing much, where those 2 or 3% could be added into a stronger area of the market. But you definitely need someone on your team that has a pulse on what's happening every single day, and look at it and give that feedback to the team and say, hey, this is what I'm seeing. Whether they utilize it or not, I just think it gives you a different perspective than watching a media outlet. I'm not going to name any, but it's just a different overall perspective. And I'll leave it at that. So coming into 2024, we had a lot of the same expectations from same analysts, thinking that this year there's going to be a recession, the market's going to go down. Pat, you and I talked to one portfolio manager, says, hey, after the first week of January, it's going to crash. Well, we're in the second week of January and it's pretty much the same level. So what kind of conversations have you guys had this year so far talking to clients? I know that, again, I've had some of the same conversations. Recession. The Fed might not cut rates. Inflation is going to go back up. Mortgage rates are going to go back up. Have you guys had any of those conversations this year?
I haven't had any conversations with clients yet. sort of waiting for some catalyst that's different from what we already expect, which is, the Fed's made it pretty clear. When they said they were going to pause last year, most people didn't believe it, right? They said, hey, we're going to pause. And we had clients come in and say, or call and say, well, yeah, but, which by the way, that if the Fed's pause now and lower rates, they're going to stimulate the economy. And that could be very good for the markets in 2024. And as we know, a high percentage of the time we have an election year, everybody has a vested interest in stimulating the economy and keeping things moving. We see good results for the markets. So, by all accounts, this could be a really good year for the markets. Though, again, if you, look at the cause effect or that predictive thinking, we've got wars in China and Taiwan, and we've got a lot of major problems out there that clients are calling and asking about, which may have zero impact on the markets. But if the Feds do, in fact, lower rates, we could see the market skyrocket. I mean, just pausing last year caused a big jump in the market. So, I hate to say it, I'm not making a call, but I mean, this could be a good year in spite of all of the negative things that you're seeing on the news.
Yeah, and market price is showing us exactly that. My biggest thing is, you all know, until it's proven incorrect, the market's overall trend is up, it's bullish. They can tell me to the blue in the face all the noise and all their opinions, but again, the market is going higher. And that's my only leading indication, because if I listen to analysts and their opinions, it's going to give me a bias, and then it's going to get into my fear, and then I might make a decision that will not benefit anybody. So trying to stay neutral and not listen to the noise, I think, is very helpful. And I think some of the lessons that clients learned last year was relying less on forecasts from media outlets and relying more on working with us and getting an opinion that's unbiased. Because again, we can't have an emotional tie to what we're doing. For example, yesterday a client asked, do you think in terms of percentages when you're allocating money, or do you think in terms of dollars? And I said, well, percentages. Because if I thought in terms of dollars, I probably wouldn't be able to hit the enter button when I'm placing a trade into a portfolio, because the amount is just too big. And I have to think in terms of percentage. That's something that I've trained myself to do, because if I look at the dollar amount, I would just lose it. I don't know about you guys, but I have to think in terms of percentages.
On some of those days where we're moving portfolios around, if you think about dollars, I'm with you. I mean, pushing the button when you're looking at the sheer volume is challenging, which is why you've got to be scientists and zoom out and take a look at, and always in terms of percentages. Even in terms of my own portfolio or clients' portfolios, a client call in and put the uptick or the downtick in terms of dollars, it can be a lot of money. But if you zoom out and put it in terms of percentage, then it makes much more sense, and again, allows the science to sort of dictate the investment policy statement, et cetera.
We understand why clients mention dollars, because that's how they pay bills. So they have a relationship with the dollar value. We can't be biased, but we have a relationship with the percentage value.
So the difference between because dollars are what we feel, dollars are emotional, percentages, as we want them to be, are much more non-emotional and sort of static. Because we all have clients that if we say, hey, like I was talking to somebody yesterday and I said, hey, by the way, just so you know, your account's up over $100,000 in the last 90 days. She's like, what? Because when you think about $100,000, somebody back in the 80s, if they made $100,000, that was great. That was a magnificent salary. And we latch on to these emotional landmarks, and we latch on to how much that money used to be, what it used to make us feel like. And so you sort of get this, sort of this emotional cost basis linked to certain things. And it could really hurt people when they look at something. Dom, you've mentioned this a ton of times. If I tell somebody, hey, you're up 12%, and they go shrug their shoulders. But if they're down 10%, they'll look at that in dollar terms, and it's a tough day for them. Okay, so here's my dichotomy on the markets. If I am a family, and I have little kids, and we have two incomes, and we're dropping kids off at daycare, and maybe we're paying for a private high school or college, and we're trying to put food on the table, and where money is flying out of our pockets right now, right? Go put gas in the car, go get a couple bags of groceries. That's a $500 day. That is very expensive to fill up the fridge. And inflation is real. Whether the CPI has truly come back down to range, it certainly doesn't feel like it. And if the guys at the top of the mountain at the Fed say that it has, it lacks credulity, right? Because maybe the math says that it has, but certainly in our hearts, it has not. So what's difficult is to say, things look like they're trending in the right way, right? These things take time to unravel. Once inflation turns over, and if it has, we're not going to know for months and months and months. But if inflation has turned over, and if interest rates do start to come down, man, this market is just poised. It's poised for a great year.
It is.
However, if it's kind of like the flu that was going around, that's 10 days coming, 20 days with, 10 days leaving is what it felt like. This market could really struggle. The other part is we used to look back and we say, how did we do this year? How did we do that year? Now, because of this volatility, that is just a crusher sometimes, right? The last 3 months, we were down 9% or down 5% in 2 or 3 days. And while you're in the process of trying to wrap your arms around that and recover from what just happened, well, 2 weeks from now, the market just went on a 9% rally. And so the hard part is, the difference that I bring up ad nauseum, which is, and Brad brought up science. I know what he was saying. There's the feelings and there's the facts. And if we submit to feelings, we're not serving our clients. If we do the math and try to get to the bottom of it and have those client conversations, then, we have better than just a puncher's chance.
That's like allowing your client to dictate the allocation that they should have. I've known a lot of advisors that have allowed clients to derail them from their own objective and their own goal because they were emotional, and it led into the advisor getting emotional with them. Next thing you know, the market tears, and then the conversations, the client didn't remember. And he says, well, that's why I depend on you. Not a good thing. That goes into having an investment policy statement and why it's important to have that versus winging it and just, oh, I think this, that, and the other, and I'm scared. Instead of going back to why you originally started working together, their emotional bias overlaps into the advisor gets emotional about it. And as you said, if the market were to rip on a 9% run, they're left behind, which leads to fear of missing out. That's even a bigger emotion to deal with. So I definitely hear what you're saying.
I've lost clients over the years, and not just because of a bias in sort of impacts my own thinking, but I've had clients say, I don't want to lose any more money. The market's down, and especially in the Great Recession, I had clients say, listen, and I've had couples argue like, hey, we should be buying, we should be selling, but it puts us in a terrible situation because if the market's down and we have someone saying, hey, I don't want to lose any more money, well, then we're forced to get more conservative because if I talk you into staying in and the market keeps dropping, we're wrong. Or if I let you get out and then the market, recovers, we're wrong. And so I've had 2 periods like this over the course of I'd say since the Great Recession, where clients come in and I allow them to dictate what the new policy is for that relationship. And it turned out badly both times. In the Great Recession, I had a client come in and say, stop the losses and make it stop. And then, of course, I wasn't going to try and change her mind because if I did and I was wrong, then, we're liable. And then, she's going to be disappointed with us. So I took her out. And of course, we know what happened, right? The market skyrocketed for the next decade, right? And then they come in and say, hey, well, you should have kept me in. It's not just that their bias is infectious. I mean, we have liability and it's almost like if we get to a point in a relationship with a client where they come in and they start telling us, hey, this is the way it's got to be. I want to make more because then we get more aggressive and then the market drops. And then you got basically 4 boxes. You can be right in 1 box out of 4 when you start letting the client tell you what to do. The only time I can be right if they say, well, I don't want to lose, and I talk them into staying in and the market goes up, is the only time our relationship is going to stay intact. So
I love what you said there, Brad. And, at the end of the day, when you have somebody who's dipping their toe into the frigid pool of irrationality, right, which is what's happening there, you only have so much empathy to deploy when it comes to, hey, if they want out, let's be honest, it's not our money. And if they want out, they want out. And Dom, you said something earlier that made me go, we should do a podcast just on the investment policy statement. I said this weird phrase early when we started this podcast, which was, what does your money mean to you? And like I've told you guys the story about how you sit down with somebody and you say, well, what does your money mean to you? Some people look at you like you've got 2 heads, and other people say, well, I'm really glad you asked. And they tell you the story about growing up without money. Or they tell you the story about growing up, hey, we used to go goose hunting when I was a kid. I'm thinking, oh, this is great for you. This is not. We had to eat those geese and we didn't like them. We hated goose meat, but we had no money. Or this other guy says, yeah, we grew up, my dad owned a restaurant. Oh, really? That's fantastic. No, it's not fantastic, Pat. We had to work in that restaurant because he had to fire everybody because everybody's stealing from him. So we didn't get to play sports. We didn't get to do stuff. We had to go and work in my dad's restaurant. So what does money mean to you? Well, then how do we put that down into something that's not one of these heartrending stories? And it's called an investment policy statement. Because what it does is it holds us accountable to them, and it holds them accountable to our initial conversations of what are your goals with this money. And just because we put it into writing in 2018 or 2012 or whatever it is, it doesn't mean that it can't be modified and tweaked over the years, right? It's kind of like the geodesic dome. The first version looked almost exactly the same as the last version, but there was 48 little incremental, small, tiny little changes, little trim tabs, I think is what Buckminster Fuller called them. And these little trim tabs they're going to happen when, hey, our kid got into college and got a scholarship. Great, that's right tail outcomes, right? Or our kid didn't get into college and we're going to have to pay for him to go to this really expensive private place because it's the only place that'll take him. Ooh, that's a left tail, right? And so we have to make these little changes to the investment policy. But typically it's, where is your heart, right? And you said it, Brad, like the paradox of investing is when the market is getting crushed, start to get a little greedy. Twist your mustache, hatch an evil plan. How do we buy a buck for 75 cents? Here's the other side of that paradox. When they're on the cover of Time magazine, if that thing's still even in print, if there is a big bull standing on a green hill with an American flag in the background, and every single non-investor in America has pulled all of their money out of the bank and thrown it into tech stocks, it is time to cover your vitals, raise cash, and have a lot of phone calls. So it's hard. You're damned if you do and you're damned if you don't. It's very tough on, I think, Mr. and Mrs. Main Street out there.
Pat, you talked about on the FOMO episode, concentrated stocks. And I don't think it's just, Mr. and Mrs. Main Street. I think, especially being advisors in Silicon Valley as we are, there's so many tech savvy or, intelligent investors here who've made a fortune on their individual stocks, and they get emotionally invested, emotionally attached to those stocks. And so hedging those stocks, selling some of those stocks, doing something, using options to protect some of their gains is a harder conversation, especially since they've made a fortune in said stocks. So it's not just the Main Street investors that are impacted negatively when the market does so well that they just won't let go of any of those stocks that have made so much money. PayPal is a great example. It's getting emotionally invested and emotionally attached to those investments sometimes, because sell high is part of that equation.
A buddy of Dominic and we've known him for years. He's a dear friend of ours, Chuck. And Chuck goes and he talks to this he wasn't C-suite. He was probably an AVP over at this company called, well, we could say it's gone, Sun Microsystems. And he goes and he talks to him and says, hey, listen, it's probably time that we take a look at, and he has that conversation, right? DOS, what are your dangers? What are your opportunities? And what are your strengths? And the guy just says, hold on, I'm going to stop you right there. You are not going to even come close to telling me to divest out of some of my Sun Micro stock. And the guy went on this rant about, I know the CFO and you should see what chart was pinned on the cork board over at the kitchen, and you have no idea where this is going. And so we all know what happened. It all ended in tears. We all know people who bought a home a year and a half later. They couldn't even afford to pay the property taxes on that home, or they bought a car of which they had to get out of. I mean, all of these things, and a lot of it has to do with concentrated equity positions. We also know many, many, many more people who sent kids to college, who paid off a home, who paid off mom and dad's home, who did all these wonderful things for themselves and for other people because they happened to go to work for one of these crown jewels of Silicon Valley, and it worked. And that's awesome. And we're very happy for those people. We work with a lot of them. But even they have seen the trail of guts that gets dragged behind the car of the reckless investor, right? And they have seen things, and they'll say, okay, we've made quite a lot of money here with this company. What should we do now? And there's no one answer. It's lots of cups of coffee at the kitchen table. These things take a long time to figure out.
As you mentioned, Brad, the concentrated equity positions, a lot of that has to do with luck. So I'm not going to say anybody is a genius, because it's just luck. You were at the right company at the right time. You got a ton of shares and it happened to take off. Great. Now, can you manage that? That's the hardest part. Going back to the investment policy statement keeps everybody on the same side of the table. It avoids confusion. It should be updated on a regular basis or at least reviewed. So instead of somebody saying, oh, I'm going to have an account review. Well, we already know what happened. Why are we going to review it? Let's make a plan going forward. But the one thing we should review is the investment policy statement. Has there been any changes to your objectives and your goals? A lot of people have a hard time separating what an objective is or what a goal is and how one supports the other. But having a clear line communication and revisiting that in 2022, which is the most recent bear market that we can utilize for an investment policy statement, you shouldn't have any questions and you should not let a market derail the goal. And we've seen a lot of that. So having a strategy meeting, reviewing the investment policy statement instead of having a financial review, I think is significantly more effective. And it is the client, the investor's job to let us know if there's been a change in objective, change in goal. We can't read minds, nor should we be liable to be able to read your mind and be told, oh, well, that's your job. Because our job isn't to change your mind for you. Our job isn't to do anything other than create a plan based on what you let us know. And the investment policy statement really does that because it's very transparent. It keeps everybody honest.
Yeah, the thing I like about the investment policy statement too is because it's really focused on goals, because we've all seen it. There's all these fancy tools out there and we utilize them too, right? Let's answer these questions and it's going to come up with a risk number that you're comfortable with on a scale of 1 to 10 or 0 to 100, whatever it is. And guess what? Guess what happens to their risk tolerance in a bear market? It goes down, right? And so guess what happens in a bull market? All of a sudden they come back as a 98 out of 100 and right. And so people's risk tolerance changes based on their emotions when they're answering the question. So what's great about the investment policy statement is it's goals-based. And again, I don't like these buzzwords, right? Financial planning, goals-based. That's our job as advisors to really have a genuine conversation with you and say, look, this money's got to last you through retirement, or this money is intended to pay for, college in 10 years, right? So when the market's down, we have a recession in that 10-year period and they come in and their risk tolerance has changed. We can point to the investment policy statement and say, really, the goal of this is to, pay for college in 10 years.
Risk tolerance questionnaire, I think, is probably one of the biggest jokes out there. There are some providers that have their cookie cutter risk tolerance questionnaire. I think it's okay. I really do think they're watered down and they're meant to just literally put you into a model, sit there and forget about it and rebalance every 6 months or rebalance annually. I'm not a big fan of them. There's only a couple out there that I've ever seen that are actually good. But the ones that I like are the in-depth risk tolerance questionnaire that are related to your investment policy statement. This way, we minimize noise from the news media outlets and the opinions of analysts and economists and just focus on what we are trying to accomplish. And that's whether it's accumulation phase to get into retirement, whatever the case might be. I like the ones that are in sync with your IPS, investment policy statement.
And let's be honest, these things are put out by every company. Says, let's take a look at your risk tolerance. All they are is a way for you to feel agreeable about getting money going and investing money. Because again, who benefits? Hopefully the client benefits. But we dang know for sure that the company that says, call our 800 number, put your trust in us, put your money to work for 40 years and never pull it out. That's who ultimately, truly 100% benefits.
I think those are companies, going with a company like that, the robo-advisors, and I'm not going to name any specific companies. I look at that as kind of like giving up.
I understand the frustration level on people who I don't want to talk to some financial advisor. I've seen these guys in movies. They're crooks. I've seen Ozark. It's like, I totally get that. But at the end of the day, hopefully you're able to talk to 2 or 3 or 4 of them, see eye to eye with them, try to find somebody who can reflect the morals and ideals and has the professionalism and the tenure. And if you can find that person, you're lucky. I'm not going to say that he or she is going to solve all of your problems, but you don't have to go it alone.
The thing about those risk tolerance questionnaires and the robos, which are great, they're, you can save money and you don't have to deal with the financial advisors because the big no-load companies are out there saying, hey, look, why pay an advisor? They can't outperform the market, et cetera. Guess what? You know how frustrated people must be when the market's down. It was down almost 50% during the Great Recession. Can you imagine calling up the company and they say, well, your risk tolerance indicates you're an 80. 80% of your portfolio is going to be down by 50%. So you're going to be down by 40%. And that's what you told us. So that's what we did. And I don't really have much to say about, so a lot of those risk tolerance questionnaires are also for the advisors to sort of cover their liability so that they can point to you, the consumer, if the market's down. And, I don't have any liability here. The market's down. You told us you wanted market exposure. And so the risk tolerance answers the question.
The one that still just shocks me, and maybe I'm naive or stupid, but when they have somebody 5 or 6 or 7 years away from retirement and they say, put your money into our lifestyle fund for your lifestyle, right? And so you go, hey, I'm going to put it into this lifestyle fund. What's the great thing about the lifestyle fund? 60% of all your money is going into an asset class that's almost guaranteed to get crushed as soon as interest rates go up. Yeah, but it says lifestyle. And that's the one where I look at that and I'm like, how do they get away with that? And I get it. I mean, there's larger forces at play. And if you don't know, it's like the people who says, hey, adjustable rates, that sounds pretty good. I've heard that those could be great. And if it works out and it goes the right way on you, man, you are psyched. But if it goes the wrong way on you, guess what? You might be out of that house.
Yeah, those lifestyle funds are interesting, especially, and this is one of the big failures in 2022. So many algorithms failed and analysts failed in 2022 because the correlation, and you both talked about that in previous podcasts, which is the correlation completely failed. It all went to, 1, right? Bonds drop, stocks drop, and bonds are supposed to, or at least theoretically or historically, can mitigate risk and smooth out the volatility of the stock market. And in 2022, they actually lost more money than most stocks, right? So those lifestyle funds just don't work if the algorithm's not working.
See, what's interesting about that is, yes, bonds and stocks were going down together. And this year, actually, the latter part of last year, coming into this year, now bonds and stocks are actually trading together, ironically enough. So there is a correlation there, which I find to be interesting. But that just shows me if the Fed does decrease rates or just stays flat, then that's going to continue because the anticipation is as rates go down, the value of bonds will go up, which can influence the equity markets to continue higher. So I think some of the key takeaways from all of this is, for me, my recommendation is going to be avoid falling a victim to overconfident predictions. Turn off the TV. What about you, gentlemen?
Let's be honest. These are very real concerns, right? I mean, if these are wars, they're real wars, some of which could come and hit, the United States, and we're economic war and et cetera. So I'm not saying that they don't matter or don't pay attention, but the market, Dominic, you've said to me many, many times, is a leading indicator and the market's going up. And so help clients stay focused on the markets and what's actually happening in the markets, as opposed to what potentially could happen if some of these things come to pass.
So mine would be this. There are 3, and again, this is something we should probably do an individual podcast on, much shorter than this one. But there are 3 distinct periods of an investor's existence, right? There's accumulation, there's preservation, and then there's distribution. Perfect example of accumulation, I think, is when you buy a house, you plan on owning it for hopefully decades. And when the real estate market goes up and down, you have to shrug your shoulders, keep paying your mortgage, keep paying for it, and eventually you'll have a store of wealth that will grow and provide for you and your family for years and years to come. And when we get caught up in the game of investing and watch the guys on CNB something, man, it's a trap, because you start to wonder, what am I doing? Why am I doing what I'm doing? And we'll talk to people and we'll say, why did you get out of the market back in 2000 and such and such? And they go, I was at a stoplight the other day. It went from red to green to red. Everybody was honking at me and I was vapor locked because I was trying to think, why did I get out of the market? And the reason is they can't tell you why, because it was a visceral reaction. They said, I can't take it anymore. And it happened. Well, guess what, folks? We're human beings. We feel feelings, and these things do happen. And I wish for that person that they would have had somebody who they could have called, who could have made them, at least for a moment, feel a little bit better about the world financially and their place in it.
Yeah, if you're working as an advisor, I would encourage you just to have the conversation of what does it mean to understand what's happening in the market versus what's happening in the economy versus what's happening in the news, because they are all 3 different things. And you're right. We should come up with why don't we do that? Work on a 3-part series of the different phases of a financial planning life cycle. As you said, accumulation, preservation, distribution. The next episode, we can make it about accumulation. What do you gentlemen think?
Yeah, accumulation it's certainly the one that most of our people are in. And because of longevity, right? When we were kids, people keeled over and died at 68, 69 years old, right? Now, when I see somebody who dies at 73, I'm like, man, they died young. But I will say this. I'm not going to speak for you guys, but I'm doing a lot of smooth talking about how great and easy it's not. I call Dominic at least once a week and I say, Dom, do me a favor, shoot this thing full of holes. Where am I way off on this? And I'll call other people and say, where am I wrong? The more you think you know, the more you know that you don't know. That's why it's like there's no free lunch in this game. And it's basically we get diversification and hopefully somebody that you can talk to who isn't going to benefit financially one way or the other from you buying X product or whatever it may be that they're selling. Hopefully you have somebody who can give you quiet, sane advice, who will work quietly in the background for you for years and years and years. And that's why we do what we do.
It's funny, Pat, you said that, you call Dominic, he's my sounding board also. I grew up without a lot of resources. And so somewhere in my mindset is preservation and fear, right? So I read a lot. And so I have to get my own emotions out of there because, when I read that the dollar's falling apart, the same thing all of our clients are hearing. I'm human. So calling both of you, actually, I call Dominic a lot and I give him my speech and he goes, so what? And I go, wait, what? Like it's like he threw water in my face. I'm like, what do you mean, so what? I just gave you every reason why I think it's going to be a zombie apocalypse and what's going to happen to the stock market if we're all zombies. He's all, it's going to go straight up. And Pat, the other thing is I call you and you have a great way of putting things into context. And so I'm very happy to have, even as an advisor with 30 years experience, it's great to have, people who are smarter and better than I to lean on.
Something you mentioned, you grew up without a lot of resources. You and I do share that. The one thing, as you were saying, I'm more a preservation type of investor. I remember I've always been into the stock market since I was a teenager and would write on what stocks I would want to buy and where I would want to buy it at. But I clearly remember I had started at Bank of America Investments and went through a training program. And Pat and his partner at the time, Chuck, were partners of mine who I would refer business to. What was interesting, though, is during the financial crisis, as you guys know, I am very energetic. I'm always pumped up. I'm always full of energy and predominantly positive. I walk into their office. I'm like, what's going on, guys? And they look so upset. And they're like, well, the market's going down. They're making phone calls, just trying to appease clients and just calm them down from making an emotional decision. And at that point, seeing everybody in the Bank of America investment office, I was thinking to myself, you know what? I really got to focus on risk management because I don't want to have the feeling that everybody in this building is experiencing right now, which is why I've dedicated so much time to alternative asset classes and managing volatility, managing risk. So interesting that you brought that up.
Let's also call a spade a spade. When we were at Bank of America Investment Services, which has now moved on to be something else, they didn't have what I would consider a good suite of tools in order to manage risk. And a lot of places out there don't have that. It's get your money in, keep it going, put your head in the sand, and I'll talk to you in a couple of decades. We're going to throw it over the fence and we'll go find it if you ever call us up and we need to look at it.
We can't raise cash because we're not going to get paid on it. That's the institutional mindset.
Ooh. Yeah, that's rough. That is really rough.
Sorry.
And so there's a lot of little games that get played at firm A versus firm B, mostly banks. But it's hard because you have these advisors who want to do well for you, who are working real hard to get your approval and to keep you happy. But at the end of the day, they don't have the tools. Well, that certainly we use.
Because we don't have company behind us paying our bills, telling us what to sell. And to Dominic's point, cash doesn't make those firms money. So you have to stay invested. Well, guess what? When you have stocks and bonds dropping, you should be in some sort of alternative or cash, but that doesn't make those firms money. So no matter what you do, you should be working with an independent who doesn't have dictates in terms of what they should have you invest in because you want somebody who's got your best interest at heart.
Right. To wrap things up, I would really like to thank everybody for tuning in. Please tune in to our next episode, which Pat suggested we'll be working on the accumulation phase of the financial planning lifecycle. And we look forward to you guys tuning in next time. Until then.
Thanks for listening to the Sage Planning Solutions podcast. Be sure to subscribe so you don't miss the next episode. If you want more information, visit our website at sageplanningsolutions.com.